Aloha, good morning, everyone. I'm Alan Hanaike, realtor here in Honolulu, and I'd like to introduce Alexa Zen. Full disclosure, Alexa is my cousin. We are related. And also joining us is her partner, also another one of our cousins, Lindsay Shawneke. So wave, say hi, Lindsay.
Lindsay's on Zoom.
She's on Zoom. So I'm going to turn it over to her, and you can set the ground rules. Whatever. Yeah.
Sure.
All good. Yeah. Thanks, guys.
I'll echo what Alan said. Aloha. Good morning. Mahalo for having me here today. I'm with a business called Ringler. My cousin and business partner, Lindsay, is also on Zoom. This is very much a family business. Today, we're here to discuss structured installment sales. Before I get into that, though, Lindsay, did you want to say hi or just give a brief intro about yourself?
Sure. Hi, everyone. My name is Lindsay Shawneke. As Alexa mentioned, I'm her business partner and cousin. I am just sitting in virtually because I actually live on Molokai. So unfortunately not able to be there with Alexa in person today, but happy to be here virtually. And just wanted to say thank you all for joining us, for listening to what Alexa has to say, and we look forward to helping you and your clients with this new product that we have available. Thank you for having us.
Great, wonderful. Yeah, so Lindsay lives on Molokai, but she does fly over to Oahu about once a month. And if you guys have any, questions in the future, or if you do have situations where you think clients would want this product, you can feel free to reach out to either of us. We're both very accessible. We're here, happy to help. Briefly about us, we work in the structured annuity industry. I think a lot of people know about annuities, or they're semi-familiar with them, but structured annuities are a little different. Just to give a brief introduction, I think it was in maybe 1979 or 1980, Congress revised the tax code to allow for certain types of annuities to be available to specific people in certain situations, namely people who are experiencing physical injuries. So then all of these life insurance companies with these special annuities, they popped up, they emerged. We have relationships with about 8 of them. One of them is MetLife. And most recently, within the last 5 years, MetLife decided that they wanted to offer this type of special structured annuity for the use of the sale of real estate. They had a pilot program going on the mainland in only a handful of states, maybe starting in 2017, 2018. However, it was recently approved for use in Hawaii and across all of the United States in March of this year. So that brings us to today and why I'm here to talk about structured installment sales. Okay, here's my clicker. Let's get started. Okay, this is just a brief outline of the content I'm going to discuss today, so you have an idea. The predominant focus is going to be on the what's an installment sale, what is a structured installment sale. I feel like inevitably when we're talking about the what, we want to know how, right? How does it work? So the what and the hows are going to be the main focus, but then the why, the who, the when, just little tips to help you visualize and understand what kind of clients or situations this might apply to. Moving forward. Okay, what is an installment sale? So this is the portion of the tax code that applies to our situation. And this is just a very layperson's definition. It's the sale of property. Property can be real estate or a sale of a business. I don't know if you folks actually help clients that sell businesses as part of their real estate too, but sometimes. Okay, so it could apply to either or to both at the same time. At a profit for which the seller receives one or more payments in the future after the taxable year in which the sale occurs. So instead of, there's my animation translation. So instead of receiving all the cash at closing in one lump sum, the seller is going to agree to receive a series of payments sometime in the future moving forward. Okay, so that's just a regular general installment sale. You don't have to use a MetLife annuity with it. Just as one example, as I mentioned, Lindsay and I, we're family, this is a family business. We actually are business partners who bought out this business from my mother. We did so in the year 2020, but we didn't buy her out all at one time. We agreed to an installment sale. We didn't use MetLife because it wasn't available at the time. But instead of, for example, using our situation, instead of buying her out just in one fell swoop in 2020, we agreed to make installment payments to her for 5 years. So we're in year 3 of that arrangement. So just an example in case you folks hadn't really come across installment sales before. Okay, so what is a structured installment sale? This is basically the name that MetLife has decided to give to their annuity product. And a structured installment sale, all it is that it adds an annuity by MetLife into the transaction. Why would you want to use MetLife? Well, MetLife is a very highly rated company. They're financially strong. They're highly solvent. I'm not a MetLife representative or employee, so I'm not so familiar with their company, but I know that they're very well, highly rated. They've been around since the 1800s. So, you know, they've weathered all the world wars so far. I don't think they're going to go out of business anytime soon. Do you have a question? Yes.
Can we get these slides?
I can. Well, he already has them, but I can also PDF them and give them to you as well.
And basically, you're kind of like a broker where you'll get products, or instead of being a mortgage broker, you'll get products from like MetLife or F&G, and then you'll provide those products to your clients.
Correct. And I realized perhaps I should have been repeating it in case the mic isn't picking it up. The question was, will there be a copy of these slides available afterwards? Yes. Second question, am I a broker that works with different financial companies and offers products to people like you? The answer is yes. But more specifically, Lindsay and I are life insurance producers. So that's the license that we have. So any products that we're offering, they're offered by life insurance companies. So not necessarily all financial products. Did that answer your question? Okay. Okay, very good. Okay, so yeah, basically we're talking about incorporating a MetLife annuity into the installment sale. I'll just pause. Come on in. Is that woman coming in too, or no? All right.
Coming in?
Oh, no, she's having her team.
All right, very good. Sorry. Thank you everyone on Zoom for being patient. We got some more people joining. Okay, I think I'm going to move on. I don't think I was going to say anything else about this slide. Yeah, let's move on.
Is Ringler
Yes.
a national company, or is it just?
Good question. The question is Ringler a national company? Yes, it is. So basically, Lindsay and I operate the Honolulu office, but there is, gosh, I don't even know how many offices there are across the country. Lindsay, you could chime in if you know. Are there 30, 50? But we're a national company. We're associated all with each other, but we do kind of operate in our own little bubbles. And I wonder if that's how Keller Williams operates too. But yeah. Does that answer your question?
Yeah, I just was curious whether Ringler was a name made up.
I see what you're saying.
Your mom made it up.
You know what? Let me backtrack a little more just to give you some context. Ringler is the last name of one of the founding partners of this company. And this company emerged very shortly after, like I said, in 1979 or 1980, when Congress revised that tax code to allow for these special types of annuities. An entire industry was created. So Ringler was the first and continues to be the oldest structured annuity company. Been around since, again, Lindsay, correct me if I'm wrong, early 80s, 79. Does that sound about right? Okay, she's nodding. Okay, very good. Full disclosure, this was before we were born. So, but yeah, we've been around for a long time. And there are other companies other than Ringler out there. I'm talking perhaps, you know, a little, well, I think I'm talking okay, but let me pause. Are there any other questions? They're all really good questions. No, please interrupt me. I feel like this is a nice intimate group, so we can have this kind of back and forth dialogue. Oh yeah, and for the folks that are on Zoom, if you have a question at any point in time, feel free to unmute yourself and ask it, or if you feel more comfortable, type it in the chat and I will periodically check with Juby about chat questions. Any questions from the Zoom people before I continue? Okay, moving on. Very good. Okay, that's right. I already went to my next slide. So since we're talking about annuities, I just wanted to briefly review what a traditional annuity is, which you guys are probably already aware of it, but just so we're all on the same page. This is how a traditional annuity works. MetLife's structured annuity is going to be a little different, so just keep that in mind. The basic definition is that it is a life insurance product which makes a series of periodic payments to an investor. And the typical example that I use is that you would purchase an annuity for yourself. right? So let's say you have $100,000 you want to invest it. You go to someone like MetLife and you give them $100,000, and in exchange, you receive a contract, which is a promise to receive, or for a promise for MetLife to pay you $12,000 every year for 10 years. So basically, you're able to grow $100,000 to $120,000 total. You're agreeing to accept these payments annually. And it can be a pretty solid and good investment. The Zoom part is blocking out a little bit, but that little box on the right says that it uses after-tax dollars. That's a key difference between the type of annuities that we deal with, and I'll get into that later. But with traditional annuities, you're using after-tax dollars because you're buying it for yourself, right? So let's say,
Oh, I'm going to fix that for you while you talk.
oh, okay. So in this example, if you're buying it for yourself, let's say you're using money that you already paid taxes on because it's money from your earnings, right? Your salary. So you've already paid income tax on it. So you just buy an annuity for yourself, and that's how it's available to you. Small kind of technical difficulties. Patience, please. We're good? Okay. All right. Well, I feel like that was a pretty long-winded explanation, but this is just what regular annuities look like, right? In case you didn't know, just a little brief refresher. That's how a regular annuity works. So let's talk about how, I don't know if this is working now.
Now try.
Okay. Let's learn about how MetLife's structured installment sale works using one of their annuities. So the short answer is, in a real estate transaction, instead of the seller is the one who's going to want this for themselves, right? They're going to want to agree to receive the money in installment payments because they've determined that it's beneficial to them for whatever tax reasons. So they're going to ask for the buyer to buy the annuity for the seller. That's one clear difference. The seller cannot buy this annuity for themselves. And this is what it's going to look like. Buyer is going to go to MetLife, involve MetLife, and then MetLife is going to make those annuity payments to the seller. MetLife has two components to it. So of course, MetLife is the overall parent company, but they have an assignment company, which handles the contract and which actually owns the annuity on behalf of the seller. And then the life insurance component, the life insurance department, which will actually make the annuity payments. So this is basically the arrangement, or this is how a structured annuity works. The key to setting up the annuity this way is that we avoid the doctrine of constructive receipt. I don't know if you're familiar with that, but essentially the IRS will tax you for money that you're deemed to have received even constructively. Constructively almost means like a fiction, right? So by setting it up this way, the seller doesn't own the annuity, and therefore no taxable event is created at the time of the property sale. And this arrangement is basically what allows the seller to receive these this beneficial tax treatment.
That's the magic.
That's the magic of it. This third-party arrangement.
So the magic is, it's a life insurance product,
Yes.
gets dumped into MetLife, and MetLife is making structured payments out to the seller.
Correct.
And then those, when it comes out of that MetLife, it gets tax-free.
So when MetLife does start making those annuity payments to the seller, that income will be taxed. However, I'll get into the tax brackets later, but you'll see how by turning like the sale of a property that maybe you would have been a couple $1 million, and then you just spread it out over time, the taxes inevitably end up being lower. Yeah.
Otherwise, it's just being taxed all at once.
Right. I have a nice slide later on that kind of gives more color to this, but I wanted to show you theoretically how this works. So not even theoretically, in practice, this is how it works. But it's not so simple as that traditional annuity situation where if you as a seller wanted an annuity, you would just buy it for yourself. You have to ask the buyer to do it for you. In real life, the buyer is going to direct escrow to wire the funds not to the seller's account, but directly to MetLife. seller is not receiving any of this money at the time of the sale of the property. And MetLife, as they make payments, the seller would be paying taxes on the income they receive in the year that they receive it, but not all at one time. Let me keep going forward. I think that when I show you more like slides and numbers, you'll see how that works. Okay. Right, this is my Brad Pitt slide, just because, why not? But has anyone, I hope you all have seen the movie Meet Joe Black. If you haven't, Meet Joe Black is really the angel of death, but at the end, they kind of play him off as some IRS auditor. And that's why he was there tagging around Anthony Hopkins the whole time. But the whole point is that why would your clients want to do this? Because the only two things that are certain in this life are death and taxes, right? So if you can reduce your taxes, then why not? Especially if you have clients where this type of annuity works best for people who are going to be facing high capital gains taxes. And those people typically, I mean, like it could be the long-term or the owner of a long-term residence where, you know, they're going to deduct their $250,000 or maybe $500,000 homeowner tax exemption, but still it wouldn't cover all of the gains that they're looking at. Or this is going to apply to business owners or owners of investment properties, second, third homes. And maybe those types of people don't need the money right away in their pockets because they're not doing this to finance, you know, the sale of their primary home immediately. So perhaps this would be beneficial to them. So why would it be useful to them? Because they're going to defer and reduce their capital gains tax liability. And also, why wouldn't adding MetLife into this situation is a good thing? Because as I mentioned earlier, they're highly rated, they're financially strong, their ability to pay is solid. I also just put a small bullet point down there. Hawaii has a state guarantee law that covers life insurance products, policies, and annuities up to $250,000 should MetLife or any life insurance company go bankrupt. I don't think MetLife's going to go bankrupt anytime soon. Like I said, they've been around since the 1800s, but you know, there's some assurances there that this is not a terrible deal. Okay, let me keep going on because then I think if you see the tax bracket, this might make more sense. Okay. So this slide just shows in a chart form the long-term capital gains tax rates for this year. So a short-term capital gains is deemed when you have an investment and then you turn it around, you sell it within 12 months. I don't think that, you know, that would ever really be applicable for properties. It might be, but if you're dealing with a short-term capital gain, it's going to be your regular income tax bracket, right? But for long-term capital gains, it depends on what your tax status is. But just to use the top one line as an example, let's say you're a single person and you're looking at selling your property. Up to about the first $40,000, you don't pay any taxes on it. Wonderful. Between about $41,000 and $450,000 or so, you're paying 15%. Anything above that $450,000 range is 20%. So let's say you're a single person and, you know, you're about to sell a property that costs, because, you know, property is so expensive in Hawaii and valuable, over $1 million. You're potentially looking at paying $550,000, $600,000 in that 20% tax bracket. But if you were to annuitize it, inevitably those installment payments are going to be, I don't know, let's say $100,000, $200,000 a year. So if you can kick yourself from the 20% tax bracket down to the 15% tax bracket, it's like you're saving an immediate automatic 5% that you otherwise would be paying to the government. So that's where a huge portion of the tax savings comes in. And then on top of that, when you invest your money with MetLife's annuity, there is going to be a return with that annuity product as well. The return rates, they vary, but maybe anywhere from 1 to 3, 1 to 4%. So you're not looking at something that's really high, but better than a savings account. It's a conservative, annuities are considered conservative investments, but I guess that's the whole point of having an investment that promises to pay you guaranteed income. You're never going to see rates that are 10 or 12%. So
So it caps at 3?
not necessarily. They have rates. So the question was, do the rates cap at 3%? And my answer was not necessarily. They have a formula that varies over time, and it depends on how the market's doing. Right now, annuity rates are very good, mainly because inflation is so high. So to everyone else's detriment, annuity owners or annuity payees are getting a great deal right now. Some of the annuities that I've been structuring for people, let's see, their rates have been like 4.5%, high 4%. But sometimes, you know, they'll be lower than that.
But if the market takes a dip and you're protected and it's not going to go like.
Correct. So another good question. So the thing with these annuities is once you agree to this type of annuity and it's purchased for you, the rates are locked in. That's the word that we use. They're set. It's fixed income. It's a promise to pay that annuity contract and make those annuity payments under that specific return rate. So in theory, if you locked in an annuity during a really great return, it's not going to change. So the rest of the market may go down, but you would still be receiving, let's say, annuity payments that are returning about 4.5%. Which for guaranteed income, I think is really good, right? Because if you go to a bank and, I mean, savings rates are terrible, but if you were even to invest your money in a certificate of deposit, I don't know what those rates are now. Is it 1%, 1.5%? Right. So, I mean, this is still better than that type of investment. Does anyone have any questions or thoughts about anything I've discussed so far? No? Okay. Okay. Anyone on Zoom? Cool. I'm going to keep going forward. Feel free to stop me at any point, people. 1 second. Do you have to click something? Okay, well, thanks for doing it for me. All right, so who is the ideal client? Basically, anyone who's looking at facing high capital gains taxes. So these are the examples that I've listed. Owners of investment properties, whether it's a second home or if it's a commercial property, office building. Owners of high value properties, because even if it's your own personal residence, keep in mind, if you're a single person, I think you can deduct $250,000 for the homeowner's exemption. Married filing jointly, it's $500,000. But anything beyond that, if you did have an improvement in the value, that's you're subject to that taxation. Long-term owners, I mean, if you can envision anyone who bought their property or their homes back in the 60s or 70s and held onto it this whole time, they're probably looking at paying high taxes, I imagine, because what did that value cost back then? 50, 60 grand, and now they're owning $1 million homes. Yeah, so that's just a little summary of who I think this would appeal to. And then the bottom portion of the slide, how do you determine a capital gain? It's the sale price minus the basis. So the basis is the original price of the real estate plus any documented improvements. Just for some reference. That's how you determine your capital gain. Okay, the next slide. So I'm gonna show you the details, general details about a structured installment sale that I did earlier this year. The closing was back in April. So this seller snuck in like right when this was made available. So hopefully this example will give more color to what I'm talking about. Okay, so in 2004, the client purchased some residential property in Manoa. This was her second home. So she was acquiring it not for herself, but with the intent to rent it out. She bought it for $750,000, which would be a steal these days, but was quite a bit of money, right, in 2004. And then after that, she makes some improvements to it sometime in the mid-2000s. I estimate she added about $500,000 in improvements. I don't exactly know for sure, but let's just go with these round numbers. And she converts them to rental units. So the main house she splits into two, and then she also added kind of like an ADU. So now there's 3 different rental units on this property, and she's getting all that rental income from it. She decides that she's tired of being a landlord, and she's in her mid-60s, and then she wants to sell it. But she also wants to recognizes that because this isn't her investment home, she's going to be paying a lot of taxes on it. So that's why she wanted to use the structured installment sale product. So in 2022, earlier this year, she ends up selling the property for $2.75 million. And I've calculated the capital gains for you. I subtracted the original purchase price of the property and the improvements that she spent on it. So she's looking at facing about $1.5 million in capital gains. And like I said, because this was her second home, she didn't have any deductions. The homeowner's deduction, she couldn't use it. So this is what we ended up doing. She decided that she was going to place $1.4 million into one of these annuities. She asked me to basically come up with some numbers so that she could have retirement income for the next 15 years. So she decided on monthly income for 15 years. When I utilized MetLife's quoting software, I think the return rate for this annuity was mid 2%. It came out to about $9,000 a month, or about $108,000 a year. Overall, she was going to make $1.6 million over 15 years. And she set it up so that the payments would begin in January of 2023. So she actually hasn't started receiving payments yet. But what she wanted to do was kick it over to the next tax year, because at the time of closing, she was keeping about $1 million for herself. So it's not like she needed lots of cash right away. So, okay, so this graph just shows you the math as I've calculated it. I'm not a CPA, I wasn't even her tax preparer, but just like using calculations, this is what I determined. And everyone's tax situation is going to be different, right? But the first, this light orange bar represents what she would have paid had she not structured anything into an annuity. And the darker orange bars that start in the year 2023 and move all the way to 2037, that represents what she's actually going to be getting in her annuity. So if you do just basic math, and again, I'm sure tax people, there's other things that go into a tax return, right? So this is just it in a vacuum, right? But if she had not structured, by my calculations, she would have been expected to have paid $241,000 in capital gains taxes for the year 2022. Because she was, the property was so expensive. Instead, she's going to be paying capital gains taxes on approximately $108,000 a year going forward. So by my math, and using today's tax rates, she'd be paying about $3,600 a year. And if you multiply that by 15 years, it comes out to about $55,000. So, using broad strokes, she saves about $186,000 in capital gains taxes by structuring her sale into this annuity.
Did you also say in the previous slide that the difference was 1.4 million versus what the gain would have been? I assume with interest and everything else would be investment.
Yeah. So yes.
So there's also the $200,000.
Yes. So there was, yes. So she saves this money in taxes, right? 55 grand, but then also because she puts her money into an annuity, and by law, it has to be a financially viable investment product. For example, some people, they might want to do this and they don't even care if they don't make a profit, right? They just, because the savings and taxes would be beneficial enough to them, but I would have to quote them an annuity that gains them a profit, even if it's a really, really small one. That's kind of like a side tangent and not really answering your question, but I guess I just wanted to say that once it was on my mind. But yes, in addition to the tax savings, she's also going to profit 200 grand over 15 years.
And the seller can decide how many years and what they want. They can say like, I want it in 4 or 15 or.
Correct. So MetLife can do annuities up until 40 years is the max. There are some parameters, for example, so 40 years is the max for them. All the payments must be what they refer to as substantially equal. So if you decide that you want your payments monthly, they all have to be monthly. If you want to do annually, then they have to all be paid annually. And annuity payments must start within 13 months of the date that the annuity is purchased. So within a year, they have to begin. Let's see what other.
What's the shortest annuity?
Right. So for example, typically the formula allows me to, at the shortest, quote an annuity that would last 5 years, maybe less if the annuity rates are good. Anything shorter than 5 years, let's say, or maybe shorter than 4 years, would have a negative return, and then I would not be allowed to quote an annuity for that. But again, that's more of like a it's not that it's against the law to make an annuity shorter than 5 years, but using their formulas, you just have to make sure that it is a financially viable product.
So the shorter the annuity, the less the.
Correct, correct. The shorter the annuity, the less of a return you're gonna, the seller would receive. And the longer the annuity, the higher return, but it kind of peaks at a certain point. So it's not like if you were to choose a 40-year annuity, you know, you would double or triple your return rate. MetLife, I think their sweet spot for pricing annuities is probably between 10 and 20 years. And then if you go any higher than 20 years, the rate will go up a little bit, but not by that much. That's just the type of business that they like to operate though. So, yeah.
Can these, do these need to, does the annuitant need to be a person, or can it be a trust, or those kind of things?
Yeah, so the
And
annuitant,
survivor benefits, or like, you know,
Oh,
when
yes.
somebody dies and stuff.
good question. Okay, so the question was, does the annuitant need to be a person, like a human being? And the answer is no, it can be a trust. If the annuitant is a trust, you just have to, there's a little extra layer in vetting, you know, so we'd have to supply the trust document to MetLife, but I've done that before. And they just want to review the trust document to make sure that the trust allows for such types of things. Also, I think there needs to be a connection between like the seller and the trust. So let's say you are the seller. If you have a revocable or even an irrevocable living trust, I mean, that would be fine. But I don't think you can necessarily assign it to any trust that I create for my own benefit.
Like it would need to be like, you know, a trustee or a beneficiary of the trust, like that kind of.
You could do that
connection.
too. Yep,
Okay.
yep. I've seen situations too where you could designate the payee to be Alexa Zen trustee for Alan Hanaike's trust or something like that.
So it needs to be arm's length. is what you're-
Yes, yes. And then the question about beneficiaries, yes. So with all annuities, you can list a beneficiary. Primary, contingent, you can list multiple, numerous beneficiaries. So essentially, if the payee, if the annuitant passes away, this passes outside of probate, and the income would be continued to be paid to whoever the beneficiaries are.
At whatever was set in the,
Correct.
Okay.
They step into the shoes of the annuitant and they receive those installments as they were previously set up. So in a sense, it could be an estate planning device if you maybe had someone who was older, right? And they wanted to set up an annuity for 40 years, but let's say they're 100 years old, you know, they're probably not going to live to their 140. They set it up, but then they list their kids as beneficiaries. Might be an interesting way to, a convenient way to pass on your estate to your heirs.
Could you ever cancel it for like a fee or anything? If the beneficiary gets it and now wants to buy a house and wants the rest of it?
Right, good question. Can you ever cancel the annuity? That's the question. MetLife offers what they refer to as commutation, commuting the annuity. You can do that, but you would not ever receive the full amount of the annuity, the full balance that's left in the account. You know, there's a formula they apply, but it probably, by my estimate, would come out to be about between 90 and 95% of the balance remaining. But yes, that is an option.
You have
Yes.
to go with one annuity of when you transfer into two different annuities or a structured, so that maybe you can have one annuity that pays you more over a shorter period of time and one annuity that pays you less over a longer period of time.
That's a good question. So the question was, can you take these funds, do you have to place into one annuity or can you structure it into two separate annuities? I don't see why you couldn't put it into two separate annuities. I'm trying to think. I don't think they would have any problem with that. But perhaps I'm going to make a mental note and I'll email back just to make sure that I'm not misstating anything. But off the top of my head right now, I can't think of any policy. I'm not aware of any policy that would prevent that. I think more than anything, I just haven't encountered that because no one's asked me to do that before, but I think they can do that. I'm pretty sure. I will follow up and then maybe email you. Okay, yes.
Being that you had kind of mentioned that it's to kind of loop it in as part of a real estate transaction, the buyer's purchasing it for the seller and so forth.
Yes.
What is the time frame Because obviously for us, as we are in a contract, how does
Yes.
that change the timeline of closing?
Right. So the question was, because this, due to the situation, does it affect the timeline of closing? And in theory, it doesn't affect it or change it at all. So, for example, I'm the person who has I'm the licensed approved broker with MetLife. You would involve me if you have a situation that needs it. And I would do my work simultaneously during closing while other aspects are happening. This can happen concurrently and simultaneously, but it's not necessarily, it just needs to happen before closing.
So to reiterate, and the reason I'm thinking of it too, is there are other types of tax deferment, like 1031 exchange, for instance, right?
Right.
That we would involve in real estate, and they are time sensitive, meaning that the exchange company, we need to work through them with a certain amount of, we can't call them the day before closing. That's not going to work. It's going to be
Yeah.
an extension of the contract and so forth, and which could result in a failed exchange.
Right.
So my question to you is there ever a failed processing of paperwork for whatever reason? Is the seller somehow maybe not qualified, whereby that could impact the legitimacy and the closing of an actual real estate contract?
Yeah, good question. Okay, so it's not like a 1031 exchange where all of those whether it's I don't know if it's 100 days or 6 months or 6 weeks, but all of those timelines get triggered. So none of that is at play. But as far as involving MetLife goes, they do have 2 forms that they require on the front end. When I say on the front end, it can happen during closing. It can happen while we're in escrow. No, I shouldn't say the word closing. I'm sorry. I'm using that word too generally. It happens while the parties are in escrow. And MetLife wants to conduct their due diligence to make sure that the parties, that this transaction would be appropriate for both parties, basically to make sure that there's a source of funding and that the seller doesn't need this money for bills or something. So there's 2 forms. If you're curious, I have them here. I can show you. There's very standard forms. And MetLife has said that they take about 5 business days to review those forms. That's all of the required timing on MetLife's part. Yeah.
So it's not like the life insurance where they're sending someone to do labs, draw blood.
Correct. So not like a life insurance policy where a nurse practitioner gets sent to check you. No, we're not worried about that. And the good news about these forms, again, like they're very standard forms. I know that the people on Zoom can't see this, but they're like a couple pages long. They just ask for financial data, what tax bracket you're in, where's the money coming from. In theory, these forms can be filled out in 10 minutes and you give it back to me and I email it to them that day, to MetLife that day. So I'm thinking that in theory, the turnaround can be quick enough where it doesn't slow anything
It sounds
down.
like a week or so.
Yeah.
Have you ever experienced something where someone filled out those forms and in the due diligence process, it failed? Like MetLife said, no, we don't want it for a variety of reasons.
No, not for my transaction this past spring. And I'm not aware of any times when they did that. But I will say that they are trusting me to be the first layer of vetting. So if I were to meet, let's say, a client that you brought to me where they wanted to sell their home and it looked like this was not a good product for them, I probably would not advise it. I guess I would have to meet your clients. I mean, this product works really well for people that just don't need the money right away. I think Hawaii is a little different because, our property values are so high, right? That I think this could actually apply to a lot of people and MetLife would be okay with it. But the classic example that MetLife has told me to stay away from is someone who needs the money to pay bills. I don't know, or they're in such credit card debt that they shouldn't be putting their money into an annuity.
I think
Yeah.
The rule of thumb is probably similar to a DST. Are you familiar?
I'm not. What is that
A Delaware
acronym?
statutory trust where you're
Okay.
making an investment into like other properties, but the way that they qualify it is you have to be a qualified investor.
Mhm.
So they want to make sure, same concept as if you're parting ways with a substantial amount of money.
Yeah.
You're not needing that money on a regular basis to survive.
That sounds about right. Yep.
So there's a
Yep.
network kind of population.
Yes.
And then in terms of I'm sorry, you
No,
have your hand up. Go ahead, JT.
No.
No, go for it.
No, I'm waiting.
All right, I'll go. So logistically then, escrow would just work with you basically to like figure out like how the check gets, the closing checks get to MetLife or whatever and stuff. Is that how does that process work?
Yeah, so that's correct. So basically the escrow officer is working with me and I'm helping to coordinate the payment. So that, I mean, it's just a very simple wire transfer, right? Escrow is just shooting the wires to the banks and or MetLife and or between sellers accounts and buyers accounts. But yeah, I was working, I was very involved with the escrow officer as well, in addition to the realtors for that transaction I had earlier this year. Yes.
My question is kind of outside the box. Let's say I've got an investor from California,
Okay.
wants to sell his property. ARPA comes in, takes 50 grand out of the transaction, holds it. Do you have an arrangement like my client says, you know what, I don't want that 50 grand already because I never touched it. I want to put it in an annuity. Have the state do that for me. Have you done that?
I have not, and right, someone else asked me this kind of question before too. Because I've only done one transaction, they didn't ask me to do that. The seller was not interested in that, but let me work that through in my head right now.
The buyer have to get involved because the seller can't buy it for themselves. So
Exactly.
the transaction's already closed, so the
Yeah.
buyer then has to kind of go back.
I think that's what it comes out to. Yeah. So the state takes that as
It's a withholding.
right.
Until they reconcile.
But they take it, or does the seller actually get it back at some point?
Well, there's ways to get it back. but
There's
you're
ways-
not gonna go do it to the next tax time, right?
I mean, there's ways to get it back, but in the worst case scenario, the withholding becomes the
Tax it comes back
in
to
the best case scenario, your CPA might get involved and say, I don't owe 50, you actually owes 20, and then they'll give you a check back.
Oh, I see. Yeah. So thank you for fleshing that out more for me. So the way that this annuity works is, I mean, I've described it all in these, these details, but essentially it's going to be reflected in the purchase contract via an addendum that MetLife has, which I understand maybe you folks have the ability to take forms and somehow incorporate them into your purchase contracts. So if the transaction is already closed, I mean, the contract's already closed, so nothing can happen for that.
Yeah.
That separate transaction because it is a done deal. It wouldn't be reflected in the purchase contract. Is that right? Because all that HARPTA stuff, is it not reflected in the purchase contract? Okay.
Well, it's.
Yeah.
Kind
it is
of.
in the purchase contract, and it's stated in there, but it's not stated how much the state's gonna take from.
I see what you're
I
saying.
think the driver of it is that the buyer's intent to purchase that annuity for the seller, that
Yeah,
ability to do that is now become historic because that.
Yeah,
I think is what you're saying.
that is what I'm saying. You're doing a much more eloquent job of saying it than I am. That was a good question though.
because then, your seller's gonna be scratching his head, what am I gonna do with this money coming to me now? Because
Right.
that creates a tax event once they take that money, correct? Because it would still be part of the income
Hmm.
from the property.
Right.
So it was just.
Still part of the
still
profit.
a taxable event once they get it back.
Yeah, I guess with the state, I don't know, is it a 1099 or some of it, they would show it as
They show the
income.
1099.
But if you had done it on time, would this have been a way to avoid HARPTA for out-of-state sellers?
If,
Like, would HARPTA still want the withholding, even if,
Well,
say you did put it in the purchase contract?
The way she describes it is it would be because you're deferring taxes. The curious thing is, on the HARPTA document, the affidavit. I don't think that I don't know I wouldn't know how to fill that out for this reason on the affidavit.
There's two forms that you fill. One is just having to take the tax out. And then you get the refund later, or you have the CPA do all the calculations. And all the documentation, they just take what's needed. But with regards to the 1099, they don't give you a 1099 for the money you're getting back. You get a 1099 escrow. And it's up to you to do the deduction from it, so.
Like, so technically you could avoid it, if you did.
well.
Don't say it. Word.
Yeah. I don't know. I mean,
Well, but how would,
I mean-
would they collect whatever percentage per year then? What would be avoided?
I kind of feel like HARPTA or FERPTA is just, it's the federal government or the state of Hawaii saying, sorry, you don't live, you're not a resident of our state or country, and we're not sure if you're gonna escape on us and pay your taxes. So we're gonna hold this until we see that you paid it. After you paid it, we'll give you the rest back. I think that's.
Yeah,
Yeah.
it sounds a little too tenuous, especially for
separate
how,
from Capital gains, which is purely just a federal thing.
And another question would be too, I assume a foreigner cannot do this type of. Annuity. You have to be a US citizen.
good question. Well, so I'm not sure. I actually think a foreigner could. Yeah. If they wanted it. I'm going through a lot of checklists in my head right now. I've done annuities with MetLife for foreigners. They haven't been structured installment sales because again, I've only done one. But as I stand here right now, I don't think that that's a 100% obstacle. I'm going to follow up on that though too. That
We're giving her a lot of
good
good.
question. No, this is good. This is good.
On wheels. A little bit there.
Any other thoughts or questions? That was a good round robin. And to the folks on Zoom, I don't know if you could hear the questions in the back. I kind of stopped summarizing all of them, but does anyone on Zoom have any questions? Juvie, is there anything in the chat? Or Stephanie? Sorry, Stephanie.
No, it's okay. No,
Thank you.
we don't have.
Thank you.
Thank you.
Welcome.
So Juvie's not. I'm sorry. I got it in my head and
No, because I had to say.
Stephanie, got it.
Everything beforehand, so yeah.
okay, my apologies, Steph. Okay, so just some last few, whoops, too fast. Wait, get that, go, stop it. 1 second, let me try that again. Okay. Last stretch for some slides. So just, kind of just covering again, like the timing of this. I mean, I feel like just involve us as early as possible. I don't think that we're really going to gum up the wheels too much, but there's always like a number of factors that might slow something down. In my experience, even with people who work with us frequently, they still sometimes get a little tripped up by the nature of this relationship and an assignment company that a life insurance company has and who owns it and what everyone's role is. So sometimes I feel like conceptually, people accepting the nature of this type of annuity can be what slows the process down. But, if you want to incorporate us even to potential clients or something, I'm happy to explain. I would never expect any of you to really explain this in detail. Well, you guys are asking really good questions. So I think you guys actually really understand this very well, more so than some of the attorneys that I've been working with for decades. Still have no idea what I do. Okay. Also, I touched upon this briefly before, but I'll say it here again. The installment sale has to be incorporated into the purchase contract. MetLife has this form. It's an addendum. It's basically a standard form, and it actually lists out the annuity benefits that the seller will have chosen for him or herself. But there's all that required language. There's also an assignment document and a representations and acknowledgement document. But again, these are all forms that you could look at it in advance, or if you're the seller and your client wants to go ahead and do this, maybe you could even like upload the forms in advance to your listing, to give prospective buyers notice that this is what is happening for your client. But yeah, just keep in mind this happens in escrow and it has to happen before closing. Right. So I earn a commission based off of whether or not I make a sale. So I don't charge anything for my consultation services or like doing all of the work leading up to the sale of the annuity. So there's no fees associated with it if you use us or if you use a MetLife annuity.
Just like in the 1031, there are fees. So how does MetLife benefit?
So they're taking that money and they invest it. They're, for the example that we use, they're going to pay the annuitant back slowly over 15 years. But in that time, they took her money and I don't even know where they put it, but They have so many different investments. They're making money. Yeah. Don't feel badly about them. They're making money.
But you think a man, that's just.
I earn a commission. It's a one-time thing that MetLife compensates me
And that's
for.
from MetLife, not
And
from
it's-
the buyer or from.
That's correct. It's from MetLife.
Kind of same as a realtor.
Yeah, I imagine that's similarly how you folks earn your money.
Mortgage broker,
Right.
broker, yeah.
Yeah. Okay. Oh, yeah, and I wrote for strategies, as a seller, you could disclose this in MLS, you could let people know in advance you want to do this. Maybe as a buyer, if the seller was unaware, maybe you could approach them with this concept and see if it applies to them. Maybe it could help you negotiate a lower price. To be honest, at the end of the day, the seller has to be the one who wants this for him or herself. But I don't know. I feel like if there are clients or sellers with a lot to lose, maybe they would want to know about this. So
Yeah. I mean, I could see, when you're submitting an offer, you're doing some research on the property, you're like, oh, they're not paying any exemption.
I think.
They're not getting an exemption on property taxes. Maybe it's an investment property. It's like, oh, they bought it back in 2000, and it's like, so you can kind of possibly initiate that conversation, from. It's like, oh, we have a way that your client might be able to.
I think that's a good conversation on the buy side or the buyer's agent side, if you're farming in an area that property is not on the market. Because that is usually the first pushback is, well, I don't know how that's something to that effect, is just one on that side. On the sell side, it's not necessarily, the safety net on a 1031 is always a DST in my opinion. This isn't a safety net, but it's another option to add in that conversation. Because if you can't find a replacement property, then what about parking it here? And this deferred option, it's a kind of, it's not the same thing, but it's in their cousins and not siblings to a 1031.
yeah, exactly. Yeah.
They both take away all the headaches of on a rental property.
Yeah.
Yeah, I feel like anyone who might consider 1031 would maybe consider this as well. It's in that
And not
category.
have to concern themselves with those timing elements.
There's also someone who's considering a DST would also perhaps consider this too.
Mhm.
The only difference is that DST is 1031 approved, so you can go from DST back to 1031, then go property, kind of back and forth. Where I think this one you escape the real estate 1031 option, so it's no longer fully like deferred in that respect, but it's now just partly deferred for the year.
Yep. Mhm. Yeah, exactly. All right, great. Let's see. Here we go. I think we just talked about all these things, but just some thoughts off the top of my head. I mean, benefits to you folks. Maybe this can create a new area of business for you. You position yourself as like a knowledgeable resource that, I feel like that's actually really beneficial in this day and age. You want to appear to be that opinion and thought leader. Even if you never end up using this, at least you can tell your clients, well, I know about this. It's sort of a thing.
Have you heard about this?
Right, exactly. Okay, so just to recap real quickly about all the requirements. So MetLife asks that the minimum amount that goes into the annuity is $500,000. But they have told me if there's someone who wants to annuitize less, just ask them. Especially if it's like 400,000. MetLife, maybe they would say yes. Yeah.
The max. So the max.
Oh, there's no max. They'd be happy to take any money you want to give to them. I've never seen them turn any high amount away. I think that if I go to them and the amount is over 1.5 million, I need pre-approval in a sense. But I mean, I've never known them to say no. I think they just want to, if there's a lot of money coming in, they want to be extra aware of it.
10 million, we don't want
Yeah, exactly.
Yeah.
Yeah, I've never seen them turn it away. And then these are the required forms. So there's these one, the seller suitability form, which kind of addresses all of those things we were talking about earlier. And two, the buyer's source of income form. That's just for MetLife to do their due diligence. That can really happen at any time. It could even happen as part of the negotiation, the offer and before the accept process. And then documents 3, 4, and 5, we have the purchase contract addendum, the assignment agreement, and that representation statement. I prepare those, of course, involve you folks, circulate them to everyone. But then once everyone has agreed upon it and they're okay with it, they're basically submitted for escrow to have everyone sign them at closing. or maybe they're signed before that, but escrow then
Record it, yeah.
Yeah.
signing and closing.
sign, yeah, however that works. Although I guess technically these don't really get like filed anywhere. They just come back to me. But yeah, I mean, I just noticed that it just kind of went around and it was part of the DocuSign process. Everyone just signed it whenever they signed everything else. Okay.
Do they ever turn down like a regular loan as a fund source of income for them, but then does the lender not like that it's going to MetLife instead of property? Like, does that ever get?
Good question. So the question is, does MetLife reject sources of funding? MetLife will not reject a traditional loan coming in, and really it's coming from, it's being wired through escrow, right? So I feel like it's really escrow that's managing that aspect of it, but MetLife just receives the money. It does wherever it comes from. I mean, in this form, like you could.
But now it's not a home loan, right? They're getting a loan to buy a life insurance policy. So maybe the lender.
No, I think it's still category. No, I think the buyer doesn't change their type of funding. Because they are still purchasing a home.
I think it's just an exchange of money though, because it doesn't
Yeah.
matter if the buyer is paying cash, if they're getting a loan or whatever.
Yeah.
The seller's gonna be paid whole, and so long as the seller's being made whole with a minimum of 500.
Okay.
As long as the buyers knows of it, knows it's it.
Yeah, you don't, right.
Okay.
Money is money. Yeah.
So kind of like from Tony's previous question about multiple annuities and Chad's $10 million worth of capital gains to cover, could you conceivably have multiple annuities like to trust the beneficiaries? So like you personally are not receiving that taxable income, so it gets
One for each.
spread out like for each kid or grandkid.
I think
or
you
like
could.
neighbor or
I think you could.
Yeah.
Well, not neighbors though.
Yeah, you are.
But you have a question in the chat, is there a specific escrow company that you would require or recommend?
I don't require MetLife, nor no one requires a specific escrow company. And I know the one that I worked with, and I feel terrible because I think the name like Fidelity or something was in the title, but don't they all have Fidelity and title and
They
something?
don't have title and
Yep.
escrow, you know.
But maybe
But there is a Fidelity, national title and escrow.
maybe I worked with that escrow company for my transaction, my sis earlier. And there was some educating that I needed to do on my part, just like how I'm talking to you folks. I had to meet with them and address their concerns. But once I explained it to them, it was fine. So I don't have anyone that I would recommend, but I suspect that because this is so new, there would be a little, educating in the beginning.
This is a new product.
So this product was approved for use in Hawaii in March of this year. It was previously available as part of a pilot program in a handful of states like Texas and California and Louisiana, maybe starting as early as 2017, maybe 2016. I don't know how many transactions there were during that pilot program.
Do you know the reasoning, and maybe it's just part of the tax law, whatever, but do you know the reasoning as to why the buyer has to purchase it for the seller through I mean, what's the nuance behind that?
So that's purely to avoid constructive receipt. That's it's that yeah. I wonder if there's a better way that I can explain that. That helps with the tax that
No, I get it.
yeah, you do. Okay.
It's the same as 1031. You can't touch it. If you touch it, you pay taxes on it.
Right. Yeah, I mean, we're working at the goodwill of the buyer. Yeah.
So you need to approve their form. Take that in and-
We'll make a new form. I already saw the form and we can make one. I'll make, I mean.
Ellen's the form guy, right?
That's the boss. Self-employed is a good one.
Speaking of nice.
I'm not using it today.
No, but it's good stuff though.
Yeah.
Yeah, this is just a summary slide, but I feel like everyone in this room has been doing an amazing job of asking questions. So I think you guys get it.
So MetLife is the only company now doing this. Are there
That's-
others out there, you know of?
To my knowledge, or at least with the companies that I do business with, MetLife is the only one. And I believe that there was another company in their earlier mid 2000s, maybe it was like Liberty Mutual that attempted to do this, but then they they made the product available and then they stopped doing it. I mean, this was again before I've been working with Ringler since 2014, so it was a bit before my time. I can't help but think if they pulled the product off the market, it's because not a lot of people were taking advantage of it. But you know,
If you sorry to interrupt, but
no, it's okay.
extrapolating like into the future with this, do you potentially see other companies similar to MetLife coming into this space to provide products if it gets more popular and stuff?
Potentially, I think if it becomes more popular and widespread, then yes. Just my general observation of life insurance companies, that they've stayed in the business for so long because they move a little slower than other industries. I mean, certainly slower than tech, you know, but so if this were to become available or more widespread from other life insurance companies, it might be a few years.
They should have introduced this like a few years ago, and like, you know what I mean? The market's like shifting to the other side. Not to say it's not useful at all, it's great,
Right.
but it's like they would have had,
I know.
like, I mean, you would have, I can already tell you in my comment, I'm like, I would have.
I know. As soon as MetLife mentioned they were doing this, but they're only doing a test, you know, a pilot program elsewhere, I begged them to make it available in Hawaii. And every 6 months, it would just be a reminder on my calendar, bug MetLife, bug MetLife. So
You
I
are related to Alan. Same reminder, but it's me.
yeah, and you know, I wish they had made Hawaii part of that pilot program, because I told them, I said, I'm pretty sure this would take off. And by the way, the sale that I did in April, I was the first one outside the pilot program, and they were all hurrahing me. But I told them, come on, guys, I told you that this would be attractive in Hawaii. You got a bunch of average, everyday, regular people facing huge gains all the time. I mean, you know, it's got to be able to appeal to someone every once in a while at the very least. But I think they didn't do it in Hawaii because our market is just so much smaller compared to states like California and Texas. They were banking on the numbers in those states, and they didn't want to pay like whatever fees they pay to do business in every state for these products until they had tested it out.
I'd be curious, do you think MetLife would share how many transactions like this have taken place, or do you know?
I don't know.
Because that would be helpful.
Yeah.
Because people are gonna go, like, what are you talking about now? And when
Right.
it's a new thing,
Yeah.
people tend to go, I don't want to be part of it.
I know.
We're like, there's a
Like if it's brand new here in Hawaii, but it has been done.
Right,
in
right,
mainland,
right.
Yeah.
But this isn't anything new where people would put their property or the fund for them property into a insurance fund or something like that, or annuity or other annuities, like that's been around for a while.
Well, in this way where it's a structured annuity and there's all of these tax benefits, this is relatively new. Like I said,
I mean, just on the buy side, this is new.
correct, I guess so. Yeah,
okay.
sure. Yeah. You could have a seller could always do this for him or herself
We could always
But without the tax.
because for
without the tax
decades,
stuff.
I
Yeah,
mean,
yeah.
Sellers have been, dumping their funds into, policies and overfunding policies in order to avoid capital gains and taxes.
Yeah, but
I do-
some people can avoid it in that way. That's why this one is so beneficial, so that you can have a payout. And that's like a structured annuity, but I think the benefit, if I'm not mistaken, the real shiny object in this whole thing is the tax deferment.
Yeah.
Right.
But I was trying to think what the risk is, and didn't you say like they want $500,000, but if they go bankrupt, they only cover up to $250,000.
So if they go bankrupt, the state of Hawaii covers up to $250,000. Yeah.
And is that per policy
So
or?
then what happens? So you lose $250,000.
Yeah, you would in that situation.
So that's the risk. But
It's a risk.
But that's a risk, but then,
Right.
then we go back to like the same people like who go, what, go buy my home, what if it's worth $1 tomorrow?
right.
Yeah,
I'm just
well, it
trying to think of like
Streets, whatever, it's the same thing with that
When it
company.
is, that's-
Yeah.
But
you
also
put
in your
around
own
the
bank
asking
account,
price.
like,
What?
Yeah, in your own bank account, your own.
It's 250.
Right, exactly.
Yeah.
Yeah,
Same.
FDIC covers only 252. Yeah.
I don't know why.
Per annuity.
So, I mean, I'd have to double check the statute. It might be per annuity or it might be per person. I don't know.
$1 million.
Alexa.
Actually, it is per annuity. That's right. That's right. It is per annuity. Yeah, thank you.
Can I chime in on that, Alexa?
Yeah,
Um,
wait, Lindsay, chime in. Chime in.
Yes, so the threshold is for each annuitant. So, and life company. So for instance, this product is only currently available with MetLife. And so even if someone tried to do 3 separate annuities, if it's the same payee for each one, the $250,000 threshold applies across the board. However, if eventually more companies started doing this sort of product, and maybe a seller was able to place like 250 or 300, or well, 500, I guess, is MetLife's preferred minimum. If they were able to place it with different life companies, then the 250,000 would apply for each life company, but it is a limit per payee per life company, if that makes sense.
She's not saying the trust, she's saying payee in that life.
No, payee would be a trust, or payee would be you as an individual.
So I can have Chad Boy. Right, all trust.
In theory, if you set up that many trusts, yes. Thank you, Lindsay. Yeah, so Lindsay's right. I mean, really, for right now, for our discussion for these purposes, it is $250,000.
Or you could have one trust with multiple different
I mean, for one
beneficiaries,
policy.
right? Because the annuitant could be a beneficiary in a trust.
Yeah, I guess so. No, but well, let's back up. No, so the payee of the policy, or the person who receives it, it would have to just be the trust. It doesn't matter how many beneficiaries, right, are in a trust. But if you did want to take that approach, I guess you're talking about setting up a trust per beneficiary, I guess. Yeah.
It still wouldn't apply because it's where the money's coming from, right? So it's a one-time.
But that's right.
250.
That's right. Yeah.
It doesn't matter where the trust was broken up. It's where the.
That's
money's
correct.
coming from, who set up the trust. That's the one-time 250 max for all those.
That's correct. I was getting a little confused. Thank you, Lindsay, for explaining that better. And like she said, if another company other than MetLife, like let's say a Pacific Life Insurance Company decides to do this, an American General Life Insurance Company starts to do this, in theory, you could get policies from each of them up into that 250 max, and then you would definitely be covered.
For all the deviants in this room that are trying to gain this.
Okay, I think that's, yeah, you guys have seen, okay, closing slide, wonderful. We made it through to the end. So this is me. I didn't put Lindsay's photo on here, but you see her lovely face still highlighted in the corner of the screen. And yeah, so I hope that all made sense. I hope you guys learned something new.